42. The investor's required rate of return is 14%. Calculate the current value of machine's unlimited shares. Okay, so here simple, all the estimates are given. 1.55 means what? 1.55 means what? D1. D1, right? D1, that is 1.55. 1.72 means? D2. D2. 1.72. And the investors expect the price of the share at the end of the 2-year holding period to be 42. 42 means? P2. And the investors required of return is 14%. That is R. And you can easily calculate PC. Right? So D1 is given, D2 is given, P2 is given, R is given. So you can easily calculate the share price. Right. What is the price? 30? 35. 39.35. Yeah, so here you need to discount and then add. Right, 1.55 divided by 1.14, that is 1.36. Here 1.14 to the power 2, then 43.72 divided by answer, you get 33.64. And when you add 33.64 and 1.36, you get 35, right? Right, the price is 35. Price is 35. Okay, so share price, that's easy. That is, if you are planning to hold the share for 2 years.
If market value is not given,
yeah, so here, that point we can't analyze because in this example, market price is not given, therefore we don't know whether it is currently overvalued or undervalued. Yeah, so that's why, in order to identify whether this is a good share to buy, whether the valuation is correct, we need the market price also. Right. So this is if the investor planning to hold the share for 1 year, and this is if the investor planning to hold the share for 2 years, and if the investor is planning to hold the share for a longer period, 3 years or 4 years, same principle. Same principle, only thing, we need the estimate for that particular number of years, right? Example, if the investor is planning to hold the share for several years, right, number of years, what is the principle? First year dividend, we need to discount at the required rate of return for 1 year. Second year dividend, we need to discount at the required rate of return for 2 years until the investor plans to sell the share. And at a particular point, investor may plan to sell the share. We need to estimate the dividend. So let's say that is nth year. We need to estimate the dividend for the nth year, and in addition to that, we need the price at the end of that year. It should be discounted at the required rate of return for how many years? 20 years. The formula looks very familiar. Why? It is exactly the same formula we use in bond valuation. Only the letter is different. Only the letter is different. So in bond valuation, what is the formula we use? Coupon for the first year, it discount. Right? There we use I for the discount rate. Discount for the first year. Coupon payment for the second year should be discounted for 2 years until the bond matures, right, in the nth year. So what is the coupon for the last year, nth year? And in addition to the coupon, we also get what? Face value, which should be discounted at the required rate of return for exactly the same principle. exactly the same price. Only this letter is different. So here dividend, here coupon. Here for the discount rate we use R, the equated nominal, here we use I, the interest rate. And here selling price, FS R. That's all. But exactly the same principle. The same old story. Same old story. You know the same old story. Right? So there is one small story told by one of my university lecturers, right? Wait, Mangala, right? Mangala Hussain, right? So he said one nice story. So he taught us strategic management in the final year. And so once he told this story about one university professor. A university professor when he is very, very old. So he has visited the university that he did his bachelor's degree. Right? So he feels so happy, right? So even he's really happy when we go back to our school. So that's why some people they are in, right? Back to school, right? Professor Giri. So right, right? So he has visited the university that he followed his bachelor's degree so many decades back. So when he went to the university, he feels so happy, right? Because many things have not changed, right? Especially state universities, right? Not changing, right? So he, right? So many things. So he feels so happy to see that same old place, same old buildings, right? And then so he was walking here and there, feel so happy. And so he during his university days, he has stayed in the hostel. So he wanted to visit hostel lodge. And so during this time, the brother and sister from the same family, they were studying in the university. So they were staying in the hostels, right? So but they are not allowed to go to, right? Boys are not allowed to go to girls' hostels, right? But so this time, so when this professor is there, that sister, she has got very urgent message from home. So she forgot the rule and she ran to that brother's room in the boys' hostel. Right? And so when this professor came to the hostel, right? And so he wanted to visit the room that he stayed during his university days. Unfortunately, that was that brother's room. Right? So when he went to the room and knocked the door, the sister is he couldn't do anything, and there had been a big cupboard in the room. So he asked the sister to go inside the cupboard, and he, closed the door. So professor came into the room, and he was working, right? Same old environment, right? Same old buildings. And suddenly, he remembered something. He ran to the cupboard and opened the door. There is a girl. Same old game. Right? Then the brother said, no, sir, please don't misunderstand. This is my own sister. She is staying in the girls' hostel, and she came here to convey urgent message. Same old story. That is the same old story. So, yes, in the bond valuation or equity valuation, same old story. Right? You can see. Periodical return should be discounted, right? As long as you hold the asset, and at the end of the year, right, the face value, right, or the selling price should be discounted. Right? But in bond valuation, it is called, instead of using this detailed formula, you can use what? You can use annuity formula. So, right? Because there you can use annuity formula. But in share valuation, can we use annuity formula?
No.
That's not possible. Right? That's not possible because dividend is not constant. Right? Actually, for share valuation, the help we can get from the financial calculator is very, very minimum. Right? So most of the cases we have to do the calculation manually and separately. But some assumptions we can use, but not for many calculations in share valuation. Right? So you can see the share valuation is not difficult with the only difficult part is the estimation of these values. Right? Once you get the estimate, the calculation is easy. Right. So the share value, so we'll say with these different assumptions, how to calculate the share price. So In share valuation, so as I mentioned, mainly the valuation, the most important assumption we need to make is the assumption relating to the dividend growth, right? So as it is given in this study text also, you can see in common share valuation, common stock, equity, right? In common share valuation, the main assumption we have to make is relating to the dividend growth. So dividend growth rate, as I mentioned, we can make that assumption in three different ways: zero growth, constant growth, non-constant. Right? Because especially if the industry is not having an idea to sell the share in the near future, or when we calculate the share price from company's point of view, we can't estimate dividend for a few years. Right? Therefore, the more logical approach is to estimate growth rate. The first assumption is so easy: zero growth. Zero growth means same dividend continuously. That means what is that pattern? Annuity. Actually, special type of it. Same amount continuously. Perpetuity. That's perpetuity. So to calculate the share price, what do we need to do? Because dividend takes the form of perpetuity. Future benefit takes the form of perpetuity. So the price is the present value of the future benefits. So you know very well how to calculate the present value of perpetuity. Right? So we discuss. So that's why now you can see the application now, the financial mathematics concept. So it is concerned. The present value of perpetuity. How do you calculate? Exactly. So that's the easiest formula. Right? So we discuss the present value of perpetuity. Cash flow should be divided by the discount rate. So when it comes to shares, what is the cash flow? Dividend. And what is the discount rate? The required rate of return. The required rate of return. Right? So discount rate is the required rate of return. So you can call it cost of capital. Right? Therefore, what is the share price based on this assumption? Zero growth, right? So we have to divide the dividend by the required rate of return, D divided by R. So it's so easy. The calculation of share price. So when we use dividend, zero growth in dividend assumption. Zero growth in dividend. The share price, that's so easy to calculate. It is D divided by R. D divided by R. Because you remember, we discussed how to calculate the present value of perpetuity. Present value of perpetuity equal C divided by I. Cash flow divided by the discount rate. So here the cash flow is dividend, the discount rate is the required rate of return R. So we don't need any example for this. Right? So we don't need any example to calculate this. Right? So if I use an example, you might feel I'm trying to insult him. So, right? So don't need any example. Right? The next assumption, the constant growth in dividend. Right? And under this assumption, what we need to do, we have to estimate constant growth rate, right? As I mentioned earlier, so in order to estimate the constant growth rate, we can use different approaches. One thing, we can analyze historical dividend pattern of the company. What is the company's dividend trend, right? We may use the data for the last few years, right? Because now even if you get one,
Decrease also, no?
it may decrease. Exactly. So sometimes there may be a decrease in trend, right? So growth rate may be negative, right? So decreasing trend. So definitely there can be a situation like that, right? That's possible. That's possible, right? Because all the companies, dividends are not growing. There can be a decrease in trend. Then the growth rate will be negative, right? So nowadays when you get even one good annual report, many companies they have 10 years of money, right? So key information there. So we can get the key information for last several years, right? And using that, for example, suppose the dividend of a particular company has increased from $150 in 2010 to 2020. That means over this period, right, over the period, dividend has increased by, what is the percentage? Dividend has increased by 100% over a period of 10 years. What is the annual growth? 10%. Is it 10%? No. Right, so that is simple arithmetic average. Right, so what is the rate we have to calculate it? Compound average growth rate. So that we have discussed. So that is one approach to estimate the constant growth rate. One approach is to use CAGR, compound annual growth rate, compound average growth rate. So you remember how to calculate the compound average growth rate, right? Compound average growth rate. You remember, right? So how do you calculate? Actually, here what happens is 150 has increased at this rate. So for the growth rate, let's use G at this rate for how many years? For 10 years, and it has increased to this. This is what has happened. This is what has happened. So you can easily calculate the value of G. Right? How do you calculate the value of G? Right? For that we need only simple mathematics. We need to write this equation in terms of G. Right? Then we can take this 150 here, then it becomes 3 divided by 150. So we have 1 plus G to the power 10. To the power 10, when you take to the other side, what happens? To the power 1 divided by 10. Then we have 1 plus G, we need G minus 1. So that's why we discussed compound average growth rate, CAGR earlier. Final value divided by initial value to the power 1 divided by number of period minus 1. Right? So you remember how to calculate CAGR. So that is one approach. That is one method to estimate the growth rate. That is one approach to estimate the growth rate, CAGR. One approach. Very commonly used method. Right? Very commonly used approach to estimate the constant growth rate is CAGR. Which shows the recent trend in the company's dividend. Actually, not only dividend. So when these forecasts are, when the companies preparing some forecast budget, this is very commonly used approach, right? To identify the average, compound average growth rate, and so with some adjustment for the current condition or the expected condition, so it's possible to focus, right? So CAGR. In addition to that, there is another commonly used method, which is known as sustainable growth rate, right? Sustainable growth rate. Sustainable growth rate. So mainly the long-term trend, in the dividend, we can get some idea using this method, sustainable growth rate, and based on that, we can estimate the constant growth. But here we have used some ratios. Right? In financial statement analysis, have you learned ratio analysis? Not yet. Start? Yeah. Early. Right. Because here also you have financial statement analysis. Yeah. You learn ratio analysis in detail. Right. So one simple ratio, because ratio analysis is simple topic, because most of the ratios term has the meaning. Right. So one simple ratio is that dividend payout ratio. Dividend payout ratio. How do you calculate the dividend payout ratio? Right. Term has the meaning. Dividend payout ratio. The company pay dividend from what? Using what? Profit. So when they make profit for a particular year, they pay dividend. Dividend payout ratio from the profit. What is the percentage paid as dividend? So how do you calculate? Dividend divided by profit. 200, right? Out of profit, what is the percentage of dividend that has been paid? Right? So dividend payout ratio. Right here. dividend payout ratio, that is dividend divided by earnings or net profit. Earnings, right? In other words, profit into 1. Simple ratio, dividend payout ratio, sometimes known as payout ratio, right? Payout ratio, dividend payout ratio, dividend, right? Sometimes, these are the total figures. Sometimes you can use per share value. Then, dividend per share divided by earning per share, right? So this you can also calculate dividend per share divided by earnings per share into 1. That is the dividend payout ratio, right? Dividend payout ratio. So that's easy. Term has the meaning, right? So very clearly, term has the meaning dividend payout ratio. Okay. Then another related ratio is there. Retention ratio. Retention ratio. How do you calculate the retention ratio? Retention ratio. Right? So what is the percentage company retain in the business? How it is calculated? Retained earning is the accumulated value. But for a particular year, out of the earnings, right, out of the profits, what is the percentage they retain? The easiest one is 1 minus payout ratio. Right? The easiest one is 1 minus payout ratio, because if the company pay 40% as dividend, that means 60% retain. Right? Otherwise, right, the retained profit for a particular year can be divided by, here it's not the accumulated. It's the only amount for the only for that particular year. Therefore, the easiest method, so as you mentioned, 1 minus payout ratio. Because if 40% paid as dividend, 60% retained. If 60% paid as dividend, 40% retained. So like that. So the easiest method is 1 minus payout ratio. Because if the company wants to grow, what they have to do? They need to retain certain part. Otherwise, if the company declare the total profit, that means they can only maintain the current level. But if they want to grow, they want to retain and reinvest. So they have to increase the investment, right? So what is the return we can expect for the retained earning? Retained earning is a part of which capital? Right, as we discussed earlier, the capital into 2 main categories. What are the 2 categories? Equity and debt. And so retained earning is categorized under equity. So what is the return we can expect for equity capital? That is what we call ROE, return on equity. Return on equity. So therefore, what is the growth we can expect? Right? So that is what we call the sustainable growth. The sustainable growth rate equal retention ratio into ROE. Right? So this is another way we can estimate the growth rate. Right? So average, the growth rate of the company can be identified retention ratio into ROE. Right? Normally, when we analyze the dividend pattern of a company, right? So different companies use different policies. Some companies, they maintain certain payout ratio. Every year, certain percentage they declare dividend. Right? 40% or 50%, certain percentage they declare dividend. Then we can see what is the retention. Right? And some so then if it is slightly different, so when you calculate the retention ratio for number of years, you can see what is the average. Right? On average, what is the percentage company retain. ROE also you can see what is the return on equity of the company, average value, what is that, and based on that we can calculate the sustainable growth. Right? The sustainable growth rate. So these are 2 very commonly used methods to estimate the constant growth rate. Right? So based on this information, possible to get some idea, right? Possible to get some idea about the dividend pattern of the company, right? But always, so it may not be increasing figures, right? As I mentioned, so different patterns can be there. So there may be a declining trend. some organization, when we estimate a rate like this, then it is possible, then we have to apply the constant growth in dividend model, constant growth model. So when we are going to use the constant growth model, now we know we can't calculate the share price this way. Both numerator and denominator will be affected when we assume the dividend is growing. Then we need to use the formula and which is, that means for the dividend we use D0, that is current dividend, into 1 plus G. 1 plus the growth rate, and we should be, even for the required rate of return, this growth will be affected. That we have to use R minus G. R minus G. D0 into 1 plus G means what? D0 means recently paid dividend, currently paid dividend, right? Into 1 plus G means that is the dividend. Yeah. So we adjust the growth rate. That means that is the dividend we expect for the next year, right? So this is the currently paid dividend. When we assume dividend is growing at this rate continuously, this is the dividend for the first year. So that means same formula you can write D1 divided by R minus G. The same formula, right? D0 into 1 plus G means what? That is D1, right? Because D0 means recently paid dividend, currently paid dividend, and D1 means D1 means expected dividend. So D0 means recently paid, dividend. D1 means expected dividend for year 1, right? So it is the same formula. D0 into 1 plus G divided by R minus G, or D1 divided by R minus G. So when you have to apply the constant growth model, whether to use the formula this way or this way depends on what is the dividend value you have. If you have the information, if you have the dividend value which is already paid, that is D0, right? So if you have the estimate for the dividend for the next year, that is D1, right? Therefore, the calculation of share price is not difficult with this assumption. Right, so this is the most commonly used assumption in equity valuation. Right, so before we move to the other assumption, we can do a couple of questions related to the constant growth model. Right, I think we can take a break. Right, so we'll take a break, and after that we'll do some questions. We'll do some calculations related to the constant growth model.
target දෙන්නේ කියලා. target දෙන්න බෑ. සිංකේ කිව්ව සිංකේ තියෙනවා 8000 ගණක් කියලා. ඔව්. සිං ලක්ෂ මතන් China to that's 14 days direct service. 8000 ගණක් කියලා. කියන්නේ වඩා පාරේ message එකක් දාලා ගන්න මචං space confirm basis තියෙනවා අපිට කියන්නේ මේ සතිය 10ක් විතර load වුණා කියලා කියනවා. වාහනේට. කලම් පොඩ්ඩක් මචං rate එක check කරලා කියනවා. හරි. මේ මචං Orient Staff එක OST combination එකක් case එක කෙනෙක්. වඩාත් අපේ general purpose check කරගන්න මචං. space කියනවා වඩා rate.
Okay. Boston growth in dividend. So this is the assumption most commonly used in evaluation, right? Actually, this formula D1 divided by R minus J. So this is called growing perpetuity, right? So in the mathematics term, growing perpetuity, right? Because it's growing at the same rate. Right, so therefore, so if you check the formula, how to derive the formula for growing perpetuity, maybe so those the engineers will be able to explain that, but that's a bit complicated, right? So because growing at the same rate, so if you check the present value of growing perpetuity, right? So that it's not very easy to derive this formula, right? So not very easy. This present value of growing perpetuity. So you have to use the common, right? So you have to take the common factor out, and then right. So it's not, ultimately you get the formula as here C is used for the cash flow for the next period in this formula. That is how it has been defined. So right. So that is how we get. But without using that advanced mathematics, we can get some idea using some simple finance concept, right? Because we know the meaning of this R. R means what? So in this formula, R represents what? Required rate of return. It is the required rate of return. So when you are going to invest in shares, normally what are your required rate of return? Is the combination of two returns. What are the two returns? We expect dividend and capital gain, right? So normally it's total return. Total return we expect by investing in shares. So we can calculate this way, right? So we already discussed the meaning of this P0, P1, D1, right? So P0 means what? That is the price we can buy the share, today's price, right? P1 means the price we can sell the share, right? Then D1 is the dividend we can expect. Therefore, what are the two returns we can expect? the total return. If you want to calculate the total return, what are the two returns we expect? D1, right? Okay, if we write the capital gain, right? P1 minus P0, this is the capital gain plus D1, right? So here P1 minus P0 plus D1. So these are the two returns we expect. These returns we can expect when we pay. What is the price we have to pay today? P0, right? When we pay this, we can get these two returns. So that is the total return, right? And even we can segregate this return into two categories. So that is what we call capital gain yield and dividend yield, right? So we call this capital gain yield, yield and dividend yield, right? So capital gain yield means P1 minus P0 divided by P0. Dividend yield means D1 divided by P0. Right? Actually, capital gain means what? We can get a capital gain only if the share price increase, only if there is a growth. Right? Capital gain indicates the growth. That is the growth, right? We expect dividend and also we expect price appreciation. Therefore, required rate of return, the return we require from a particular share is the combination of two returns. That is the combination of two returns. So we can write. So it's a logical write R, the required rate of return. The required rate of return is the combination of dividend yield and capital gain yield. Capital gain yield. Capital gain yield means the growth. Capital gain yield means growth. Right? Therefore, we can write this formula, the required rate of return. So in this formula we use R. R equals dividend yield. How do you calculate the dividend yield? D1 divided by P0. D1 divided by P0. And capital gain yield means growth. So if we use G here, right? I think it's logical to use that way. Now, if you rearrange this formula in terms of price, what do we get? Yeah. So if we write this formula in terms of price, so right, what we want to calculate is P0. Right. Then this G, when you take here, it becomes minus, right? R minus G. Then we want P0. And P0 equal what? P0 equal D1 divided by R minus. Right? So, is that clear? Because here, there we get the formula this way. R equal D1 divided by P0 plus G. And G, when you take here, it becomes R minus G equal D1 divided by P0. And now, when you write the formula in terms of P0 equal D1 divided by R minus G. So that is the formula with D1 divided by R minus G. Therefore, without using this very advanced mathematics, right? So using this simple principle, we can understand this. Right? Therefore, so constant growth model indicate that, right? The constant growth model, so we can get that formula this way, right? So that is the thing, right? Because many formulas we use, but we didn't discuss how to derive that. So that is not necessary, right? Because mathematicians have done that. So we have very simple task, right? Actually, when we learn this finance, we have very simple thing to do. The difficult part they have already done. Right? So the difficult part they have done and nicely documented. Right? So we have a very simple task to read and understand. Right? So that is how we calculate the price when we use the assumption that the dividend is growing at a constant rate. Right? Okay. So when we use that assumption, so here in that previous note, we discussed we'll do some question, some calculation using the constant growth model. Last I mentioned, so we can use this formula, the d0 into 1 plus d for d1, that is based on the dividend value we have. If we have the dividend already paid, that means d0. If we have, right, so if we have the information related to the expected dividend, that is d1, right? And so that's what we call constant growth model. This model also known as Gordon growth model. So that is the name of the person who developed this, the Gordon growth model. D1 divided by R minus D. Right. Okay, so let's do this calculation, this example. Down Under Financial recently paid a dividend of 180 Australian dollars. 180 means what? 180 means it's D0 or D1? D0, right? Paid. So that's easy to understand whether this is D0 or D1, paid dividend. That is D0. And analyst has examined the financial statement and historical dividend policy of Down Under and expect that the firm's dividend rate will grow at a constant rate of 3.5% indefinitely. The analyst also determined Down Under's required return is 10%. Calculate the current value of Down Under's shares. Right. So we can easily calculate the price. Right. So based on this information, we know 180 means D0. Right. 180 means D0, and the constant growth rate is 3.5%. Right. That is D is 3.5%, and it has been estimated the required rate of return is 10%. That is R. R is 10%, so we have to calculate the price. That's very easy to calculate the price, right? So here we have D0. When we have D0, right, so we can use the formula this way: D0 into 1 plus D divided by R minus D. Right, so we have all the value, right? Value for all the variables. We can very easily calculate the price. So it is 180 into 1.035 divided by 10% minus 3.5%, right? So you get the price. What is the price? Price is 28.66, right? 28.66. $28.66. Okay. So when the growth rate is given, so we can easily calculate the price. And sometimes, so when we know the price, if we consider that price is fair, we can estimate the growth rate also, right? So the reverse calculation, right? So in that case, it is called implied growth rate. Why? So then we have to consider the current price is fair, right? Otherwise, we know this the current price means not P0, as we know. Current price means not P0. So that's why in previous calculation we used in one example, current price means what? That is the market price. But if we consider the market price is fair, then we can estimate the growth rate, right? Same concept we can use reverse calculation, right here. So calculate the implied growth rate. Assume that the current price and the most recent annual dividend for Aurora Mining are 24.25 and 1.10 respectively. Right. This 24.25 means what? That is the current price, which we need to consider as what? P0. Right. So we consider as P0. That is market price actually, but here we consider as P0 $24.25. And the most recent dividend, that is D0, right? Recent dividend means paid dividend, right? Recent dividend 8.1. If the required return is 8.